Yes, so according to CME's FedWatch tool, the market at the moment gives a 97% likelihood that the Fed cuts by 25 basis points and only a 3% chance that they keep policy rates unchanged. Yeah, so the CME FedWatch is based purely on the futures and options pricing of the CME's Fed Funds futures contract. And so essentially there's a futures contract for every month of the year, and it allows traders to hedge against the possibility of upward and downward moves in rate expectations for the Federal Reserve. So the Fed funds futures is very different than the Fed's policy rate. The Fed's policy rate is the rate at which they lend money to banks overnight. The Fed funds futures contract essentially is based on the Fed policy rate and is based on the average level of the Fed policy rate over a given month. But it largely represents a market anticipation of what the Federal Reserve might do. And the Federal Reserve's and the Fed funds futures contracts anticipations are constantly changing in function of new information and trading activity. So this is based purely on the derivatives pricing in the market. This is not a result of any algorithms at CME Group. It's purely a function of how traders and investors in the market are pricing the probabilities for the upcoming Fed meeting. So I would think from the Federal Reserve's perspective, they are probably seeing this as a preventive measure, because I don't think that the Federal Reserve believes that the United States is already in a recession. In fact, most economic indicators continue to show slowing growth. Now, that said, I do think that there is a risk of recession, and it's something the Federal Reserve would probably like to avoid. Well, I think that depends on how strong the consumer spending is. And I think that there are a number of concerns that are developing regarding consumer spending. For starters, we're starting to see very rapidly rising defaults or delinquencies on both credit cards and auto loans. Secondly, the average amount of savings that Americans have has declined very significantly over the past few years. So I think there is a risk of weakness in consumer spending, which could potentially put downward pressure on consumer stocks later this year. Yes, absolutely. I think that the strength of consumer spending as we move into November and December could tip the balance one way or the other between a soft landing and a recession. And the reason for that is that consumer spending in the U.S. is nearly 70% of gross domestic product. So it's the single most important thing that happens in the U.S. economy. Personally, I am most concerned that we will have a hard landing in the United States for the simple reason that the Federal Reserve increased interest rates by the most since 1981, over 500 basis points of tightening, and that we're starting to see a lot of stress on consumer finances. So my fear is that the U.S. is heading towards a recession, but I hope I'm wrong. Yeah, so the yield curve inversion can be an important indicator of the economy, or the shape of the yield curve more generally can be an important indicator of the economy. But I think it's often misunderstood. The yield curve is an indicator of where the economy might be in 2 to 3 years' time. It's not an indicator necessarily of where it's going to be in a couple months' time. But the yield curve has been inverted now for the past 2 years, and we are starting to see more and more signs of an economic slowdown. So that's a very good question, and it's a difficult question to know the answer for certain. My sense is it is still reliable, but there are two counter arguments that I think are important. So one counter argument is that the yield curve has become sharply inverted because inflation rates have been falling. And so that's sort of a happy reason, because it allows the central bank to ease policy in response to falling inflation rather than falling economic growth. The second possibility is that many years of quantitative easing have removed a lot of U.S. treasuries from the market, and similar in Europe and Japan, which may have artificially flattened or inverted the yield curve simply by removing a lot of long-term bonds from the market, thereby distorting the yield curve as a signal for the economy. Yeah, so part of it is just the idea that banks essentially borrow money from depositors short term and they lend long term. So when the yield curve is very steep, the banks have very large profit margins and therefore extend credit to more people. On the other hand, when the yield curve inverts, the bank's profit margins shrink because their cost of funding increases. And therefore, they eventually become tighter with credit. And this is something we're seeing happening already in the U.S. economy, where the banks are raising their lending standards and therefore cutting off credit to weaker borrowers. Well, yeah, that is the entire risk of rate increases, is that eventually it withdraws credit from a portion of the economy, and thereby slows economic growth and hopefully slows inflation. But the risk of higher inflation in the future, I think, is very real. The United States, Japan, China, many Western European countries are running very large budget deficits. And many of the factors that help to keep inflation rates low and stable, including expanding global trade, reduction in trade barriers, reduction in geopolitical risks, have gone in reverse these last few years. And so we may be setting ourselves up for a period like the 1970s, where there were several waves of inflation that took place over a period of a decade. Yes, so pre-COVID, the neutral interest rate in 2018 and 2019 appeared to be around 2%. And at that time, core inflation was also around 2%. Now core inflation rates are significantly higher. They're more like 3.3%. And so at the moment, Fed funds futures are suggesting that the Federal Reserve will ultimately bring its interest rate down to around 3 3/8%. So the market seems to believe at the moment, this can always change, that the neutral rate of interest is perhaps around 3.375%, give or take. Well, so that's a good question. You know, before the global financial crisis, there was a widespread assumption in the market that interest rates should be roughly equal to nominal GDP. So if you had 2% growth and 2% inflation, interest rates should be around 4%. Following the global financial crisis, the assumption was that interest rates should probably be below the rate of core inflation and well below the rate of nominal growth in GDP. And part of the reason for that is that debt levels in the economy have risen enormously over the last several decades. And now, just in order to keep the economy stable, we have to have a lower rate of real interest rates than we used to in the past. So the assumption post-2008 appears to be that the neutral rate of interest is somewhere around or maybe even slightly below the rate of core inflation. So that's a good question. I mean, on the one hand, once the election is over, that will lift some of the uncertainty surrounding U.S. government policy, which may produce some additional investment in the United States as well as in other countries. But longer term, I think it will really depend on what the new president, whoever that individual is, actually does in terms of fiscal expansion versus reducing deficits, and what their policies are towards trade, and what their policies are towards the independence of the central bank. Yeah, so I think with respect to the trade issue, I think that there are substantial differences between the candidates. One candidate has proposed a 10% tariff on all goods coming into the United States and a 60% tariff on goods coming in from China. The other candidate has proposed really no change to those tariff levels. With respect to central bank independence, under the current administration, we have seen the largest interest rate increases since 1981, with essentially no criticism from politicians regarding those interest rate hikes. The other side has taken a different approach. They may want easier monetary policy or a weaker dollar, although I'm not certain about that. And then finally, with respect to fiscal policy, I think both candidates have fiscally expansionary policies. But the actual results of their governance may not be the same. One may be more fiscally expansionary in reality than the other one. Well, I suppose all candidates' policies in every country are almost by definition designed to win votes. Now, what is not clear to me is what might actually happen in reality. Would such tariffs actually be implemented? It's a little difficult to say. In the previous administration, there was a 10% tariff placed on about $200 billion worth of Chinese goods and a 25% tariff placed on $100 billion worth of Chinese goods. By our estimate, this had a relatively minor effect on U.S. price levels, probably raising inflation by 0.2 or 0.3%. The new tariff proposal is much larger, much more dramatic, affects, at least in how I have read the policy, the entire world, as well as much larger tariffs on China. If those were to be implemented, by my sort of back of the envelope calculation, it would not be surprising if that raised prices by as much as 2% for U.S. consumers, which could cause the Federal Reserve to think about a tighter monetary policy to counteract inflation. But there are many hypotheticals because we don't know exactly what the actual tariffs might look like. Some people have suggested that the tariffs are maybe not going to be implemented, but are there mainly as negotiating tactics with respect to other countries. So the actual effect could actually be much smaller than what the proposal in its sort of raw form seems to suggest. Yeah, so China's economy has slowed down a great deal over the last few years as real estate prices have begun to fall and as construction activity has declined. Residential construction grew to be nearly 30% of China's GDP, and it's now shrinking at a rate of over 10% per year, which has reduced China's growth rate by roughly 3%. From its previous growth rate around 6 or 7% down to maybe 3 or 4% economic growth. And falling real estate prices have led Chinese consumer spending to be extremely weak. And so the government has now proposed a series of stimulus measures that they hope will counteract this weakness. Well, I think it's a very necessary first step, and it may work in the sense of slowing down further economic deterioration. But there are a couple of things about this package that I think raise a few concerns. First, it's not particularly large. They have proposed a 1.8% of GDP financing of local governments who have depended historically on land sales for their main source of revenue. And in addition to that, there's a 0.8% of GDP bailout, or essentially recapitalization of the nation's largest banks, and also a 0.8% of GDP borrowing authorization on the part of local governments to consolidate some of the private sector debt from the property developers onto their local government balance sheets. So this may help to stabilize economic conditions in China, but it's not clear that this is enough to actually significantly boost China's growth rate. Yeah, so I think in many ways comparing China to Japan is a very interesting analogy. What the Japanese discovered was that as their debt levels rose, it became more and more difficult to stimulate economic growth. So 15 years ago, during the global financial crisis, China implemented a massive stimulus package that was very successful at raising their economic growth rate and the entire world's economic growth rate. At the time they did that, the total debt to GDP in China was around 140%, combining the public and private sectors. Now that has grown to 290% of gross domestic product, nearly 300%. And so what the Japanese discovered back in the 1990s and what the Chinese seem to be doing today is that by adding stimulus at high levels of debt, they basically help to refinance the existing stock of debt rather than adding new investment or spending to the economy. So essentially it stabilizes the economy, but doesn't necessarily cause an acceleration in economic growth. Well, so for example, some of the ideas in the stimulus program to take private sector debt and to move it on to the public sector books simply move debt from point A to point B. Likewise, what we found in the United States and many other countries after the global financial crisis, when our real estate sector was sinking, is that by allowing the government to run large deficits, we essentially allowed the private sector, including the consumer sector, to reduce their degree of financial exposure and leverage. And so it was a subtle way of transferring debt from consumers also onto the public balance sheet as well. But it did not, however, produce a great deal of strong economic growth in the United States or in Western Europe. In the decade after the global financial crisis, most of our countries were happy to have 1.5% or 2% economic growth. But there was no economic growth of 4, 5, 6, 7%. So I think in China, the main challenge is that consumer spending comes to only about 35% of GDP, which is a very low ratio. In most economies, like in South Korea, Japan, Western Europe, the United States, consumer spending is usually 60 to 70% of GDP. And so I would think that China could achieve higher economic growth if they were able to boost the consumer share of GDP to a much, much higher level. But doing so is a challenge because at the moment, the average Chinese citizen saves 30% of their income. And part of the reason for the high savings rate is that there's not a strong social safety net in China in terms of unemployment insurance, old age survivors insurance, or social security, as we would call it in the United States, et cetera. And so establishing these kinds of programs to give social insurance can allow people to reduce their savings rates and then boost their consumer spending. Well, I think that many countries in the past, including the United States and Japan, and also South Korea, have done what is called the investment-led growth model. The United States did that in the 19th century up until the Great Depression. Japan and South Korea did that up until 1990 and 1998. And this investment-led growth model can be extraordinarily successful in taking a poor country and making it middle income. And the problem is eventually the return on investment begins to decline as the economy matures. And then it's necessary to pivot to a domestic consumption-led growth model. And I think it is time for China to make that pivot to a more domestic-led consumption growth model rather than an export-led investment growth model. I think that they can emerge from the middle income trap, but it may require structural changes in the economy, as we mentioned, to support the consumer sector and to reduce the degree of reliance on the investment-led, export-led growth model. Well, I don't know if the nature of government really matters so much in terms of the effectiveness of the structural reforms, so much as just getting the structural reforms in place. I can tell you that in the United States, it was not easy to put such reforms in place. Essentially, in the United States, the economy collapsed between 1929 and 1933. And when a new administration came in 1933, it took them maybe 10 or 12 years to put all of these programs into place, including unemployment insurance and Social Security, that began to stabilize and grow the U.S. economy. So it's not always an easy process for any political system, but it can be done. Well, in the U.S., the U.S. does have a social safety net, through unemployment insurance that's been remarkably flexible over the years. During periods of strong economic growth, one can only normally collect unemployment benefits for about a 3-month period of time. However, during periods of economic crisis, like during the global financial crisis or during COVID, the Congress can extend that for as long as they like, in some cases up to 2 years. So having a flexible regime where you can have sort of modest unemployment benefits during periods of prosperity and more generous ones during periods of economic stress can help to manage the economic cycle. Europe, where I live, is an enormously complicated place. I have dual French and U.S. citizenship, and I live in the United Kingdom. In Europe, I would say, generally speaking, Northern Europe, Scandinavia, Germany, the Netherlands, favor a policy called flexicurity, where they tend to protect the individual somewhat more generously than in the United States, but with a great deal of flexibility for private enterprise. In much of Southern Europe, the regime is less flexible. The benefits tend to be more generous and more permanent, and that can result in higher structural rates of unemployment. So I think, with any welfare state, there's such a thing as too much of a good thing, and it can also be structured in a way that is too inflexible. So I think it's kind of a question of finding the optimal point for each country, and that also depends on the country's own unique political culture and economic culture. So I think it depends on how generous the benefits become. It is possible, and I think this is the case in some European countries, that the benefits can become so generous that it serves as a disincentive to work, and as a result of paying for the benefits, the tax rates can also go to very high levels and serve as a disincentive to investment and wealth creation. So it's always a question of getting the optimal point right. If you wanted to sort of automate it, you could have the length of the unemployment benefits vary with the unemployment rate. So when unemployment rates are low, the benefits automatically become less generous. And when unemployment rates go higher, they become more generous because presumably there's a lot of people out of work. And the argument for that is, while it could potentially serve as a disincentive for people to re-enter the job market, you have to remember that one person's spending is another person's income. And if people have no income, they cannot spend money. And if they can't spend money, other people lose their jobs. So such a system can prevent a downward spiral in economic activity. But yes, it's also true you don't want a welfare state that is too big, too generous, and smothers individual initiative and economic growth. No, I don't think that that's the case. It's that, in the United States, when we began implementing such policies, savings rates stayed high for a long time, but they gradually declined as people gained confidence that, they could always access unemployment benefits in the event of an economic downturn. So during the 1920s, when the U.S. was still on the investment-led growth model, personal savings rates were very high, often 20, 30% of income. So when the United States was following the investment-led growth model, the United States often had very high savings rates. And as the sort of social welfare system in the U.S. and in much of Western Europe after the Second World War was implemented, eventually those savings rates declined to maybe more like 5 to 10%, depending on the country. In the U.S., sometimes recently even lower, maybe 3%, which is perhaps dangerously low, because people came to, over many decades, realize that they could rely on these systems in the event of an economic downturn. So I think that, it can take sometimes a long time for people to change their psychology towards savings and spending. It doesn't necessarily happen overnight. But, China doesn't have to go from 35% to 70% of GDP consumer spending all in one day. If that consumer spending can rise as a share of GDP, say 2 or 3% each year, that can add to a very consistent period of economic growth that could go on for many decades. I think it's difficult to know for certain. The Chinese economy can surprise us. For example, they had a very strong wave of growth around 2017 and 2018. Again in 2021. So I would follow their economic indicators closely to see how successful this stimulus program is in boosting economic growth. But it is true, to me anyway, that the size of the program for the moment seems a little bit on the small side. And with a very high level of public and private sector debt, the economy may prove harder to stimulate today than it was in the past. But, we'll have to see how the economic indicators come in and hope to see a strong revival of growth. Well, I don't have any power over what people in the Middle East do. I would say in terms of the impact on the oil market, which is how most of the rest of the world experiences the conflicts in the Middle East, the impact thus far has been relatively small. The main impact has not been on crude oil production at all, but rather on the amount of traffic, shipping traffic going through the Red Sea and the Suez Canal, which has declined by roughly 85%. And so the impact of this is that the large number of ships, both oil tankers as well as other kinds of cargo ships going on that route, now have to circumnavigate Africa, which is adding perhaps an extra 9 to 11 days to the journey, which is reducing the spare capacity in the global shipping industry and causing the cost of shipping to rise. So the world is, I think, experiencing this through a slight uptick in inflation in recent months in many countries, including the United States, where we saw slightly higher core inflation rates. But the price of oil has been trading in a narrow range now for the last 2 years between roughly $65 and $85 per barrel, and right now happens to be directly in the middle of that range. So the Fed's interest rate hikes happened because of a tremendous surge in the rate of core inflation, which rose to a level of nearly 7%. And I think the main reason for that surge in core inflation had nothing to do with geopolitics. And in fact, most of that increase in inflation happened before the outbreak of conflict between Russia and Ukraine, in a long time before the outbreak of conflict in the Middle East. And it was driven primarily by government spending, which in the U.S. rose from 20% to 35% of GDP during the pandemic. So in the absence of a surge in government spending or other fiscal support for the economy, I don't think it's likely that we'll see a huge surge in inflation of that degree that would cause the Federal Reserve to reverse course and raise interest rates. So government spending looks set to be fairly stable. Neither candidate has proposed large increases in government spending. However, both candidates have proposed various tax breaks. One candidate wants a $50,000 tax credit for people starting their own businesses and a $6,000 tax credit for people with newborn children. The other candidate wants a $5,000 per year tax credit per child, as well as tax reduction for people earning tips and overtime pay, etc. And so these tax reductions could stimulate consumption and eventually could prove to be inflationary if they are enacted. But in order for them to be enacted, it requires also support from both houses of the United States Congress and not just advocacy from the White House. So it's not really clear exactly what policies will be implemented. So the period during COVID in 2020 and 2021 saw vast increases in government spending. The United States is an example, but essentially almost every country except for China dramatically increased government spending during COVID. So in the United States, for example, in March 2020, we had a $3 trillion piece of legislation to bail out American families and businesses from the effects of COVID. In December 2020, we had another $900 billion. In March 2021, we did another $2 trillion. So that added up to $5.9 trillion of government spending, of which the Federal Reserve created $4.9 trillion of quantitative easing to buy that debt off of the public markets. And similar things happened in Europe, Japan, many other countries. And that was the impulse that drove up inflation, to my mind. Nothing like that is happening at the moment. Well, so for example, in the United States, government spending rose from 20% to 35% of GDP between late 2019 and early 2021. Since then, it's fallen back to 22.5% of GDP. So as a share of GDP, it's higher now than it was before COVID, but it's come way down from its peak. And accordingly, inflation rates have also come down, but they're still higher today than they were before COVID. One of the dangers, though, is that politicians all around the world have discovered that they can do massive fiscal stimulus in response to various kinds of events like pandemics. And so you can't rule out the possibility that someday in the future we could see a large fiscal stimulus, but we're not really seeing that happen anywhere in the world right now in October 2024. I think, yes, what economists refer to as fiscal dominance, the idea that fiscal policy can take the place of monetary policy as a source of stimulus. Politicians did not really act on that much in 2008. There was a little bit of fiscal stimulus, but it was mostly easier monetary policy. It produced a very slow, very disappointing recovery in many countries. And with COVID, they tried the opposite approach, a massive fiscal stimulus. And politicians have discovered that they can now do this. So you can't rule out the possibility that they could employ these tools again at some point in the future, but we don't know where or when it might happen. Yes, possibly. I mean, I think that asset markets have become accustomed to seeing monetary policy eased when the economy is in distress. And also now we have become more accustomed around the world to seeing large amounts of fiscal support. Now the constraint has always been inflation. You can do as much liquidity and as much fiscal support as you like until inflation begins to take off. And so the problem is we have now hit up against that constraint. We have a better idea now of where that constraint is. But there is always a risk that we could be turning into a more inflationary psychology, like the world was in during the 1970s when we saw successive waves of inflation and a great deal of price instability. It was, by the way, not a good thing for most asset markets. I think there are always tail risks, in the economy. For starters, if you look at the implied volatility on options across many different markets in many countries, they're selling generally at fairly cheap levels. So the cost of insurance on extreme price moves is relatively low in the markets, which makes me a bit nervous as central banks drain liquidity from the system by keeping tight money and reducing the size of their balance sheets. Historically, in response to inverted yield curves or higher short-term interest rates or quantitative tightening, we have often seen a rise in market volatility. And so we haven't seen that happen yet, but I do think it's a risk. Also, high-yield bond spreads look very narrow to me at the moment. I would think that there's some potential for much wider spreads in the corporate bond market. And, I think that there are, obviously a lot of geopolitical risks should the conflict in the Middle East expand further. Well, a lot of countries around the world are running enormous budget deficits. Maybe 5 to 7% of GDP. That's the case in China, Japan, the United States, France, Italy, the United Kingdom. And their central banks are all cutting interest rates. This could potentially make precious metals like gold look very, very attractive relative to other assets. I think that the lagged effects of tighter monetary policy throughout the world could push the economy in many countries closer to economic downturn, which could have a negative impact on corporate profits and equity markets. But that's not the only possibility. There's also the possibility that central banks could achieve a soft landing, in which case asset markets might react very positively. But in any case, I would think investors should be prepared to see a much higher level of volatility going forward than they have seen in the recent past. Thank you so much.